Years now a bit. The past calendar year was a bit of a roller coaster for the economy, from the surge of cryptocurrencies to a surging housing market to a spike in inflation. What does it all mean for your financial stronghold heading deeper into 2022? And for more of that, we turn to CPA Jim Lineweaver of Lineweaver Financial Group. Always a pleasure to talk to you, Quarterback Jim Weaver. We like talking about that, the financial quarterback. First up, let's go over 2021. I always like to gauge the markets by how I'm doing personally. I look at my 401k. Last year, 2021, for my 401k and everyone else watching, was generally a pretty good year. Go over 2021 for us.
Yeah, it was. Just to reiterate, I'm actually a certified financial planner, so not a CPA, so I don't want to confuse people out there. But needless to say, hey, last year was a great year. You know, the S&P 500 was up about 27%, the Dow was up 19%, the NASDAQ was up about 21%. So a couple of great years back to back. This year's going to be a little more rocky, but, you know, the unemployment rate fell from 6.7% all the way down to 4%. The problem is inflation started to rear its ugly head. So hovered around 7% towards the end of last year, and that actually put a lot of pressure on bonds. So as a matter of fact, that was one of the worst bond markets in history. Matter of fact, one of the fourth worst, because the bond market in general was down about 1.6%. So big dichotomy in fixed income versus the equity markets last year.
So let's go over 2022. Inflation. How does inflation really affect our portfolios, if you will? You know, I never spend more than $50 on a pair of blue jeans. Last time I went to the store.
Well, then you might be okay, but for a lot of the other consumers out there, it's going to be a little tough. You know, your $50 maybe went to $60.
$60? No.
People,
I just bought a pair last week.
And even food is going up. So,
$60?
Yeah,
the grocery store, crazy prices. But how is that really going to affect our retirements?
Okay, well, what it does, it really affects the investments that people are making in the market, right? But also in retirement, it's going to take more out of your pocket to buy those goods and services that you want. So the Fed just came out yesterday. We're expecting probably about 3 rate hikes this year starting in March. However, relatively speaking, even if we get close to, 1% out there with the Fed funds rate and things, it's still going to be relatively low historically. However, compared to what we saw in the last couple of years, with the mortgage rates below 3%, we could see them closer to 4, and they've already etched up to that. So, we just got to be careful, because more inflation that's out there not only takes away from people's purchasing power in retirement, but it also reduces the earnings on companies. And really, the stock market is a multiple of earnings. Whether you measure it by the S&P 500 or the Dow, a lot of times you use a price-to-earning ratio to try to get a valuation on the market overall.
Let's talk about, you bring up retirement and coordination. Let's first talk about coordination. Why is coordination so important right now?
Well, what happens is you have to make sure you're dotting all your I's and crossing your T's, because you could have the best returns in the world, but if you lose it all to taxes, what good did it do you? Also making sure that your family and stuff is well taken care of. So what we do is we kind of quarterback our clients' finances, so we coordinate all the financial, tax, legal, and insurance, and all those things have to really be operating on all cylinders in order to be able to have a good and really comfortable retirement.
48, Jim. Trying to get to retirement. I'm looking at my Apple stock right now. Apple, come on, Jim. Apple is walloped down. Well, actually, it's bumping back up a little bit today. Give us some inside. Give us some inside tips. For those more savvy investors who are trying to make some money this year.
Well, we'll see if we could get you retired by 50. I mean, maybe not all the way to 83 like in the Supreme Court. But needless to say, what you're going to see more this year is a shift of style of investing to value versus growth. So growth, people were looking at, those high PE, price earnings ratios that I mentioned, that might have been a multiple of sales. They might not have even had any earnings. Well, those companies that did so well the last couple of years, they've been annihilated in the last 3 to 4 weeks. So some of those have dropped 20, 30, 40%. Maybe at some point they're going to be a bargain again, but the shift is really more towards value over this next year. And we saw this towards the second half of last year as well. So value stocks are ones that may be undervalued. They have a lower price to earnings ratio, and they may pay a dividend, which for people in retirement is great, because even if the market's fluctuating, their portfolio may be down, but they can rely on those dividend producing companies and rely on that income if they're taking that to support their lifestyle. My
Tesla's down, my EMPH, the solar panel company, is down. This is not a good day for me.
See, those are growth oriented.
Jim,
so
real quickly,
you got to talk to a good CFP to get over to the value side.
You're not our Monday morning quarterback. You are our Sunday morning quarterback. We're thrilled to have you here on Fox 8. Your show starts at 9:55 Sunday mornings, and what can we expect when we watch you?
Yeah, what we do is we're bringing you up to speed on a lot of these things, the financial, tax, legal, and insurance, all about that coordination. So we always have great guests throughout Northeastern Ohio on the show. Very informative, short, sweet, to the point that a lot of people get a lot of great information out of it.
Going deep, folks. Financial quarterback Jim Lineweaver. Pleasure as always. Thanks, Jim. Good having you here.
Thank you. Take care.
All right.